All right, guys. Thank you for your patience there. I'm still working on the handoff between the Trader TV stream, but it's great to have y'all in here. I see y'all in here. I see you waiting. I appreciate you. We got some good stuff today. It is going to be a very, very good stream. I think it'll be very actionable stuff, and we'll be able to use this every day in our trading. So it's going to be good stuff. Before all that, happy Easter. Hope you guys are going to enjoy your long weekend. I know I will. It's been a spicy week, and I think we could all use an extra day there. So, all right, let's get into it, guys. Let's get into it. There we go. I'm learning, guys. This time you'll see the beginning of the presentation. So we got a topic here: constructing an actionable watch list. So what does that mean, right? We're going to be talking about all the components of a watch list that you should have up at all times on your screen when you're trading, and it'll give you a lot of insight. It'll tell you a lot of hand tips, a lot of tricks that you can kind of use to inform your bias on the market in any given day. So for me, it's absolutely crucial to be watching these things. And some people just trade looking at SPY, or maybe they have SPY and Qs. And for me, I can never go back once I learn this stuff. So I'm really excited to share it with you. And yeah, let's get into it. We're going to be talking about just the basics. I'll get into a little more depth of what I just mentioned. The stock indices, which is obviously the biggest component of this. We have SPY, we have QQQ, the tech index, we have Russell, IWM, the small caps. And yeah, those are the biggest ones. So we'll focus on those. We have bonds. Bonds are very key, especially in these kind of tumultuous times where forecasting political events and all of that kind of stuff is a really big component of market directionality. So we're going to talk about how they usually work. And also we're going to talk about some of the differences that I'm noticing recently since the new Trump regime and all these tariffs. So it'll give us a lot of stuff to work with there. It's very good stuff and very important. A lot of people don't talk about bonds because they're kind of like the hidden dark side of the market, but they're really important. So we'll get into that. We'll talk about the US dollar, another huge component of US equities in particular, but world equities. The global economy is still pinned to the US dollar. So it's really important to know what it's doing. We'll be talking about VIX, the volatility index or the fear index. Going to be talking about how that can influence your trade ideas, maybe if it will lead you towards or away from options trading. Maybe some environments we'll talk about how they're better to trade shares in, some benefit options traders. So we'll talk about that. We're going to go over the top 20 market cap stocks in terms of how we can use that information as well to kind of inform our bias and see the turning tides throughout the day. It's really helpful for that. And as well as the sector ETFs. That's another huge part of catching these intraday trend shifts, seeing where the money is moving from sector to sector. And we'll talk about the why of each of those. So if you're like, okay, energy's going up, what does that mean? We'll be talking about that too. After that, we'll do some Q&A. And yeah, I think it'll be a good time. So tune in. So what are the key points here? So why a structured watch list is so critical is because it gives you a one-stop shop, a little panel on the side of your charts that gives you so much information. It gives you more information than anything else on your screen, I promise you. If you're not trading with the watch list, I just upped your trading game by, let's call it 10%. Why not? So yeah, it's good stuff. It's good stuff. We have we're basically going to be talking about how institutional traders use macro plus micro indicators. So, there's all sorts of things like we talked about bonds and the dollar being more of a macro indicator, and then maybe VIX being short term, kind of watching the intraday stuff or the sectoral rotations intraday. That's more of a micro indicator, I'd suppose. We'll be covering, like I mentioned, indices, bonds, dollar, VIX, the top stocks and sectors. It'll be good stuff. So the key indices or indexes, as some would say, are obviously SPY. That's the top 500 companies essentially. And that you monitor that for the broad market health. If SPY's not doing well, most stocks aren't doing well. And it's kind of that simple. We have the QQQ index, which is honestly quite similar to SPY nowadays with the dominance of tech in the past 10, 15 years. So if Qs aren't doing well, SPY isn't doing well either, almost always. So that if we see relative strength in QQQ over SPY, then we can assume that there is money going into tech, right? Going into this risk-on environment. And similarly, so for IWM, that's the smaller ETF. That's 2,000 stocks that are more small to mid cap. And those guys are going to be indicative of overall market health if we're in unprecedented, scary times where, and they're also very rate sensitive, tech as well, but I would argue IWM even more so. So all of these kind of components and how they interact are going to help inform our bias, not just intraday, but on the market as a whole. So I mentioned a little bit, if SPY and QQQ are rising, you're going to be bullish. You're going to be bullish. You're going to be looking for setups in individual names or on the indices themselves to take trades to the long side. And if IWM is lagging, it could show that money's coming out of these small caps and that there's some choppy seas on the horizon. So it's really helpful to keep an eye on that stuff. So let's jump into bonds. We're eating the frog first. We're tackling the hard stuff first. This is the smart money indicator. Smart traders trade bonds. Institutional traders trade bonds. They are harder to forecast. They're in some ways their kind of own thing, their own microcosm of financial sorcery, if you will. But there's a few that are really important to watch. So you have TNX, which is the 10-year treasury yield. And then you have TLT, the 20-year. There's also TBT, which is the 30-year. And these are the three that are most important. They're the three that I have on my watch list. But we're going to especially focus on TNX and TLT. Mo, we got a bond trader in here. She says smart traders in quotations. You're smart. You're smart. I've learned a lot about bonds from Mo. So thank you for being here. I appreciate that. So the key tickers are TNX. We have the 10-year yield, and rising in general equals bad for growth stocks. And if TLT is up, it's usually risk off, and down is risk on. So in general, there's an inverse correlation between these bonds that we're talking about and their yields and the market, because as the market gets more risky and people are saying the risk reward really isn't there in SPY or Qs, they're going to look for safer places to put that money. And that usually is in bonds, because, it's hard to bet against America long term. We've been doing very well for a very long time. And so this is kind of how I would use them. If TNX is rising and QQQ is falling, it's probably a rotation out of tech. People are going from tech companies and they're going into these shorter dated bonds. So is TLT rising but SPY's falling? That would probably indicate a shift towards defensiveness and defensive names. And we'll be talking about in the sector ETF section what individual names you might be looking for to kind of lead this move and maybe trade those names. So yeah, TLT recently, I do want to say it's acting as a leading indicator, and it's very interesting to me. This is not I haven't ran the numbers completely. This is just kind of vibes, but it feels like they are kind of operating in lockstep, and we are losing some of that correlation of SPY up, bonds down, and vice versa. So I've been watching TLT and having that up on my screen, and often the move in TLT will lead the move in SPY. So it's something to consider. I think it's really important to kind of understand the chain of events for these ETFs. So for example, let's talk about Apple. How about NVIDIA? It's a fun one. So NVIDIA is a big component of QQQ, which is a big component of SPY. So if, say, SPY and QQQ are relatively flat, we're not sure on the direction, but then we see NVIDIA and it starts ripping. It starts looking really constructive, pushing out of a base. And what'll happen? That will need to be rebalanced in QQQ. So QQQ will start getting bought. And then SPY, as QQQ is a large component of that, will lag that a little bit, but it'll start to catch up. So for those scalpers out there, those cowboys, it's great to have QQQ. And also I would say the four generals, like Apple, Microsoft, Amazon, Google. I'd throw NVIDIA in there. Some environments, Tesla's good to watch. Some of these big component tech names, and you can start seeing, it's really, really cool, this complex puzzle that you'll start seeing emerge where there's always give and take between the big guys. But in general, when one starts moving, it'll kind of pull the others up. It'll start pulling the indices up. So you can see NVIDIA start ripping, take a position in Qs, and you can get a little bit of a better entry, a little bit of a front run on that move. So it's super key to watch, especially for the short-term traders. So next up, we have the dollar, the US dollar. This is the global liquidity gauge. This tracks basically how much money is in the US market in a way. So one way you can look at it. So why does it matter? If Dixie is up, the dollar, DXY, in general, it's bad for commodities and it's bad for emerging markets. As the dollar goes up, the ratio gets harder for these foreign companies to kind of foot the bill for the difference there. And then if Dixie's down, it's good for risk on assets, like good for crypto, good for gold, good for I don't know why I put gold in a risk on asset. I guess because it's acting like one recently. And traditionally gold is a risk off asset because it's a more of a finite resource. That's what we used to pin things to way back in the day before Nixon. So way before that, I guess. But yeah, anyways, these are all things to consider when you're talking about Dixie, when you're talking about bonds, that how they all move together and kind of inform your bias. So that's the kind of big takeaway that I'll keep bringing things back to. This is all to basically use all of these tools as to form confluences that'll help you trade throughout the day. So yeah, in general, 105 and 100 are pretty key levels to watch. Keep an eye on that. I haven't checked Dixie this week. I've been a bad boy, so I should check in on that and maybe update this. But that's just something to consider. Dollar is quite important, and you'll be seeing more of that relevance going forward as you'll start hearing more and more about potential de-dollarization or stuff happening with BRICS. Basically other parts of the geopolitical economy moving away from dollar dependence. So all things to consider. We have VIX, the fear gauge. So this goes up when all your favorite stocks go down and you're not opening your broker because you're too scared to look at the losses. And we've all been there, but it's really important to watch VIX. Oh yeah, Ali mentions Dixie 99.44. So there we go. We are in a little bit sketchy territories there in terms of a weak dollar. So it's something to consider, something to watch there. The fear gauge, back to VIX. The key levels in general are under 15, so like 14 to 16 range. That's kind of complacency. And you can look for maybe overbought conditions, and not necessarily short, but just wait to get your buys in and buy on the pullbacks, because in these low VIX regimes, especially under 12, you're going to get, that's like the snapback rally that we've seen like from 2023, 2024, where just, we're down a few percent, probably time to buy some calls, right? When VIX is lower, calls are cheaper because calls, being a leveraged instrument, they need to be priced according to the potential moves. So if there's higher volatility, the stocks are going to be more volatile. They're going to have bigger moves. So the options are going to require a higher premium to pay, or, to get involved with that trade. So I like trading options when we are under 20 and ideally under 16. If we're under 12, I'm never really touching common shares because, come on, it's a little bit boring when you could get that juice for a relatively cheap price. And you have a pretty easy directional bias, usually long if we're up, and you can buy pullbacks. So VIX over 30 indicates some level of panic in the markets. As you can see recently, it can go much higher. We've had some wild spikes up to 60, 80 in the past, stuff like that. Maybe 100 in the future. Who knows? It's a wild world. The important thing to remember is that volatility needs a reason to stay elevated. That doesn't mean that it has to be a binary event. It doesn't mean it has to be one single thing on the horizon to keep that VIX elevated. It could be a contribution of multiple factors, which I think is why we're seeing VIX stay elevated right now. There's a lot of risks to price in and a lot of radical reassessments of really long-term systems of global economy in terms of the tariff implications, so and the negotiations surrounding that. So VIX is very important to watch in this regime. It's very important to keep an eye on, and it should be informing your bias. So I like to have SPY, QQQ, VIX, and either the dollar or maybe gold or maybe TLT. I'll use that panel to kind of flip through some of these indicators if I only had 4 to choose from. I have another monitor, so I have a bunch of other ones up on the screen, and we can talk about that as well. But yeah, in general, these are the really important components of market directionality that are really important to watch. If you think the chart looks kind of good on SPY, but you're not really convinced, but then you see VIX start looking constructive too, and you're like, oh man, we got a game of chicken here. Who's going to win, right? And oftentimes, the VIX will kind of lead the SPY a little bit. So maybe the SPY buyers are a little more complacent and a little more willing to hang in there and see how it plays out. But the fear buyers, they're going, I don't know, man, I don't like this. Let's get some exposure to hedge. So yeah, keep an eye on that for sure. So top 20 market cap stocks. Why are these important? They're important because, well, The ETFs are ETFs. They're built off of their components, and they're weighted based on primarily these top 20 stocks. So sure, there's another 480, but let's be real. We don't really care about number 465 or whatever, we care about the big boys. We care about the ones that are weighted at like 8%, 5%, 3%, anything over 1% is worth kind of having in your sphere of awareness. Because as we saw with Dow, for example, today, UNH is down 20%, and that hurt Dow. That's 8%, 8% of the index, the Dow Jones there. So just something to consider there. Alrighty. So an example of a watch list is like for tech, maybe you're looking at Apple, Microsoft, NVIDIA, Google, Meta. I mentioned these names before. We have Apple, Microsoft, Google, and Amazon are usually considered the four generals. I definitely would contend that now NVIDIA is well in the mix. Maybe we got an extra general there. Meta's amazing. Meta's just keeps on going up for the most part. Netflix, we saw earnings today. They are a monster in the space. So if I had to pick like 6, it would be these. But a year ago, Tesla was in my big names rotation there. So it's important to kind of keep tabs on the top market caps as things progress in the market. And you can check on that really easily at finviz.com. There's a screener for, you can sort all stocks in the market by market cap, and then boom, you got it right there. And then you can build your watch list, just put those all in a little tab, a little section. So for me, I have my indices on top, the ones that we mentioned, SPY, QQQ, IWM, TLT, TNX. I have those next to each other so I can monitor the prices fluctuating between them. I have VIX right up there. I have gold. That's another good one. And then I'll have these top 20 market caps right under that. And these are really important because if you can sort them, like in TradingView, for example, you can sort by strength per sector, or I'm sorry, per section on your watch list. So I can sort who's the strongest in the top 20 sector or top 20 stocks right now, who's doing the best today, who's doing the worst. And that's really, really useful information for your trading directionality. So for growth, Tesla and Amazon, they're both the biggest parts of consumer discretionary, XLY, and they're very key for tracking consumer sentiment, essentially. If nobody's spending money, they're not buying Teslas, and they're buying less dumb stuff on Amazon. Or cool stuff on Amazon, I guess. I don't know about you, but I make some dumb Amazon purchases when my personal consumer spend feels strong. So something to consider there. We have defensive names like J&J, Johnson & Johnson, or PG, Procter & Gamble. These names, they produce a lot of staples. They produce a lot of things that people got to buy no matter what. So if we're thinking about the market as kind of a merry-go-round, or like a bunch of baskets that are getting money pulled from one to put into another, because really not that much money leaves the market or comes into the market on a given day. It's usually just shifting around. So if money's coming out of the Tesla buyers and the Amazon buyers, where is it maybe going to go? Maybe it's going to go into the more defensive names. Other ones like that are tobacco names. Stuff gets hard, people keep smoking. It is what it is. It is what it is. So how we can use them, I've been mentioning some ways, but like if Apple and Microsoft, or maybe Amazon, because Microsoft's been pretty weak lately, if they break support, then we can infer that Qs are likely going to follow. Often these levels of support on indices and major stocks will align with each other for good reason. They're very, very interlinked. And so, like I said earlier, you can use these big names, the directionality in these big names, to help trade the indices. So you don't have to worry like, oh man, I'm missing this move in Apple, because you can use that to bolster your trade and get yourself a little cushion. So yeah, if NVIDIA rallies, semiconductors probably follow. If Tesla rallies, XLY probably rallies and follows, and that kind of stuff. If ExxonMobil or Chevron rallies, then probably XLE will follow. And if you're ever not sure about this and you want to dig a little bit deeper underneath the hood, you can Google blank ETF holdings, and then there's a really great resource. I forget the name of it, but it's going to be the top result, and they'll break down each ETF by weighting. So you'll see, okay, ExxonMobil is 15% of XLE or whatever it may be. UNH is 8% of the Dow Jones, and so that's really great to kind of conceptualize how much each stock matters. And Michael, I see your questions there. We're gonna jump into the questions at the end, just so I don't lose my train of thought too much, but I'm not forgetting about you. Sector ETFs here, why they matter. So sectors move in cycles, so tech leads in growth, like when we're in a growth environment, a risk on environment. In recessions, things like utilities or the staples that we mentioned, tobacco stocks, stuff like that, those are going to lead the way up. If you look at Philip Morris PM, it looks like a chart of gold or something, which again, risk off asset in some degrees. If things are uncertain, you're going to buy gold bars and smoke cigarettes, and just kind of how it is. So institutional money flows, they show up here first. So like I mentioned, we can catch these moves in indices early by watching the sector ETFs. And, we can catch the moves in the sector ETFs by watching the individual names. So all stuff to consider. So we're going to go over the spiders here, the spider ETFs, all the X names. And we're going to talk about what they kind of do to the market. We've mentioned a few, so I won't spend too much time on like tech, but it's really important to kind of have a good understanding about what each component of these does to a market. So XLK is tech. That's the tech index, tech ETF, and it leads rallies and it's very sensitive to rates. We have XLV, that's healthcare, and that's going to be defensive and it's going to be stable during volatility, because they're less sensitive to tariffs, for example, or a lot of other things that maybe would move a Apple or a Google. Because, hey, at the end of the day, we're all going to need healthcare. And hey, if stuff gets bad, maybe we're going to need more healthcare, right? So you'll see money going into there. Thank you, Tim, for posting the Sector Spiders link there. Great stuff. So let's move on to energy, XLE. It tracks oil prices, and we can use this as a reading of inflation, essentially, because when oil goes up, everything gets more expensive. We need oil to transport things, to heat houses, to do just about anything you can imagine. It requires some sort of energy to power it. So if the input cost, energy, goes up, then that will cause inflation. It'll get passed on to the consumer more often than not. So oftentimes you'll see XLE. If XLE is at the top of the sector list for the day, you'll also see names like XLV up there, other defensive names, XLEU, utilities. So just something to consider there. And we have XLF, that's the financial sector. So they rise with rates and economic health. If economic health is strong, these are going to be doing great. If they're doing weak, you got to be a little bit careful. That could be a sign of turmoil in the financial markets. And turmoil in the financial markets will bring everything down. If anybody was trading around in 2008, you already know this story. So keep an eye on that one for sure. Also, in terms of weighting, the ones that are most important for SPY are going to be, obviously, tech is number one, but financials, healthcare, and energy are the next runners up there. So those, if you are only going to watch 4, I really recommend watching all. But if you're only going to watch 4, those are the ones you should be keeping an eye on. So we got some smaller ones after that. We got XLI, that's the industrials, and that's like an economic recovery play. Those get hit really hard in recessions, but they bounce back really fast. You'll get that kind of snapback, kind of bullwhip effect, so to speak. We have XLY, that's big ticket, retail stuff like the Teslas, the Amazons, all of that kind of stuff. XLP is a safe haven. That's the food and household goods, the Procter and Gamble's, the Johnson and Johnson's, those type of names. What else do we got? We got utilities, XLU. So again, when stuff is sketchy, when things are getting hairy and nobody knows where to put their money, you always got to have infrastructure. You always got to keep the lights on and keep the water running and stuff like that. So XLU is a great place for money to flow. You can consider it a lifeboat, like some of the other names I mentioned. XLV is probably the closest analog there. And yeah, that'll be a warning sign if you see XLU start to break out. That's spooky stuff, right? And often you'll see games of chicken happening where XLU is breaking out, but hey, tech doesn't look that bad right now. You got to watch and see which one fails. If Qs start turning down to XLU just keeps on going, watch out. That's a big risk off indicator. So we have XLRE, that's real estate, sensitive to interest rates there as well. And the last one here is XLB, which is that's the builders index, kind of the raw materials. We also have XLM, which is materials. So this is, I guess, a little bit different. It's going to be like house building companies, and that'll track inflation and prices on commodities, because it takes takes commodities to build houses. So yeah, a lot of stuff to work with there. So how we can use this is, like I mentioned, we can compare relative strength. We can see if tech is outperforming healthcare and be biased toward growth. If XLE is rising faster than utilities, then that's or I'm sorry, if if XLE is rising while utilities fall, then that could be like an inflation trade. We have divergences to spot. So, for example, here, if SPY is up but the financials are down, there's weak breadth, which means basically the things that are pulling up the market are isolated to a small sector of the market. So maybe tech is really outperforming, but for some reason financials are underperforming. So that can be kind of interesting to note because the breadth could close the jaws, so to speak, and you could see either tech coming down to match financials or financials rallying up to meet tech. So you can pair this with macro signals, like if TNX is rising, watch out for financials to go up and tech to go down. And if VIX is spiking, then you can watch for defensive sectors to start rallying, like we talked about. And here are the top 3 ETF charts to check daily. This is interesting. You can do ratio charts, right? So on TradingView, you can do XLK with a slash and then XLU. And whatever the front one is, that's going to be, if the chart goes up, it's going to be because the front name is going up and is stronger relative to the other one. So this is a really easy way to visualize sectoral shifts, especially over longer time frames. I love referring to these charts. So, and I'll give you an example. I've been a big semiconductor bear since the top, and a big reason for that is that I saw this leading sector, the one that really contributed to the big rise up in SPY over the past years, start to underperform software. So for me, I was looking at SMH, the semiconductors, over IGV, which is a software ETF, software as a service. So essentially hardware versus software. And for the first time in 10 years, you would see a breakout of, to the upside in terms of, so it's actually IGV over SMH because IGV is the one that I'm watching break out there. And it is starting to outperform in the first time in over 10 years. So I would expect that trend to shift. I will be buying dips in software and I will be selling rips in SOXS. And I'll tell you right now, it's been a very good trade for me this year. I've been in and out. I like using SOXS, another levered ETF. And, it's been really nice to be able to hedge my short positions with long positions in tech and know that if the market just chops around and I don't have a pure directional bias, I can just hold equal weight in both and I can trust that I will outperform the market. So really good stuff there. I highly recommend you check out these ratio charts. So the ones mentioned here are XLK over XLU, so growth over safety. That's how you can visualize that. XLE over TNX, energy over the 10-year yield, and XLF versus SPY. So financials would confirm broad market strength. If the banks are doing well, everything should do well. So let's talk about some questions here. I'm going to go over the starred ones and then feel free to add some more. All right. We got Day Party Experience, new listener tuned in. Thank you so much for joining. I appreciate that. We got Spencer. You want Steve now? You got him, buddy. You got him, buddy. Tyler, yes, I was gorging on M&Ms. Let's get to some questions here. Does Dow have a place in this at all? Yeah, it does. So that is one that you can look at it's a little bit different because it's only 30 stocks and they're kind of, I don't think the weighting is as insightful as a lot of these other ETFs, which is why I didn't mention it. I was kind of trying to keep it a little bit simple. And let's see, let me get in the habit of throwing this up on the screen. There we go. Cool. So yeah, we have it's definitely important to watch Dow. They're generally going to be more defensive names. There's a lot of things like UNH or big like aerospace companies, Boeing. If we're in a scary geopolitical climate, maybe we could look for strength in that and money going from Qs to the Dow Jones index. So yeah, it's worth keeping an eye on. I do have that on my watch list as well, but it's not one that I'm like laser focused in on most days. Although today it was pretty telling because obviously UNH was very, very heavy and that pulled that down as well. All right. Michael Anthony says Pfizer had a big beat, which all last year, that earnings they kept beating and getting new drugs approved. And already this year they have a few approved where people need to take the medications every day. So yeah, that's a great example of a relatively defensive company in a sense that they do have steady pipelines of things that people need to keep taking. They are pharma companies are a little bit tricky to read sometimes because they are very contingent on certain risks that aren't there for big healthcare companies like UNH, for example, or Cigna. And those can include like patent cliffs, can't talk today, patent cliffs. So, if one of their patents expires, it could really open up the door to changing their financial situation. There could be a lot of disruption in the space. Ozempic was very disruptive for a lot of other companies, for example. And so it's interesting, and I'm a tourist in the space. I'll be the first to say. So I don't have any super insightful things to say about Pfizer in particular, but because of you, Michael, I'm going to keep an eye on it for sure. Let's see. Also, you mentioned that because they raised an extra cash of 3.24 billion and have been beating earnings, and they also have a few over-the-counter drugs that people buy all the time. So let's see. Depending on how much time we have, we can maybe look at the chart real quick too. And how would I use these to trade penny stocks? Great question, Ali. So I would say that watching IWM would be very important for penny stocks. I would probably be looking to short penny stocks if IWM is weak, and I would be looking to go long if IWM is showing relative strength and kind of leading the way up. Because then people are saying, hey, my risk appetite's there. I wanna take some stabs at some fun stuff, some small cap stuff, and I really want that extra torque that small caps provide. Because I think us small cap traders know, there ain't nothing like catching a big mover in small caps. You get 20% like boom, and it's a lot of fun, right? So let's see what else we got here. Tyler says, what sector would you say weighs the heaviest on the SPY in the overall market? Absolutely tech. So tech is going to be the biggest component by a long shot. Ever since all of these monopolies like Google and Amazon and Netflix and Apple, they're just exponentially growing in the past 10 years. And it's what can you say? Tech is the giant, and as long as tech goes up, we're all right. If tech starts falling, then watch out, right? So that's the biggest component. Then I believe it is XLV after that. I got to check on the weightings. It's been a couple months since I've really honed in, but XLV is a very large component. These giant healthcare companies, they also are pretty monopolistic in a lot of ways, and they control price pretty consistently. So they're a large component there. We also have XLF, the big banks, another big area, and the last one that I think is worth mentioning is XLE. About 10 years ago, or even more, I guess, you would see a lot of dominance in energy. And there was even time, maybe I think in 2022, where you saw a lot of dominance in energy, and the ratio or the holdings in SPY, the percent that was energy companies, I think it almost doubled from I want to say 4 to 8% or something over 4 months as Chevron went crazy and went up 40%, as Exxon and all these smaller exploratory companies too just started ripping like crazy. So it is important to kind of keep tabs on them as the trading environment develops, because they can shift like that. But yeah, those are the biggest right now. All right, Rocky. We got, hey, Steve, I am from Ontario, Canada. Welcome. Elbows up. Hell yeah. And what would you recommend as far as option trading strategies in this market? So I think that there are much better environments to trade option strategies in. I'll be the first to say that. Usually, like we mentioned earlier with the VIX, we want to see a VIX in a 12 to 16, maybe up to 20 regime to really be too invested in options, because when you have this volatility, they're so darn expensive. I was watching, I track premiums on 0DTs on SPY and Qs, and the amount that they're charging is just wild for relatively small moves. And to me, that's the risk reward just isn't there. So I've been using the VIX to inform my bias of instrument choice, and I've been trading a lot of these leveraged ETFs. So the 3x levered ETFs like SQQQ or TQQQ or SOXS versus SOXL, stuff like that, because you get a lot of juice, especially because in these higher volatility regimes, there are big moves. I just caught a 13% move on SOXS overnight, and I know some people who bought SOXL when I sold my SOXS, and they're up about 10% on that already overnight. So, these move pretty fast. You don't have to juice your returns with options. If you want to, though, there are a few tips I can give you. So the first one is I'd highly encourage you to apply for level 3 options trading, and that gives you access to vertical spreads. And so what a vertical spread does is that you can buy the call that you usually do. Say you're trading hood a week ago, for example, and it was around 40, and you're like, I think it's going to 45. Spoiler alert, it did. So you think it's going to 45. I don't think it's going to 50 though. So instead of just buying the 40 strike, you can buy the 40 strike and sell the 45 strike against that. And so what that does in practice is it's like saying, I don't need that extra risk on the top. I'll sell that to someone who's more degenerate than me and thinks that it's going to double in the next week or whatever, and they can pay for that. And I can use that to subsidize my long purchase. And so then also if the trade starts working, and you'll see that as time goes on, theta or time decay will actually work in your favor because it starts hurting the other call that you sold more than it's hurting your safer call. So that's one thing you can do. Another thing is you can look into a little bit more advanced trading strategies. You can sell options or you can sell option spreads, and you can look into debit spreads, for example, or credit spreads are the other one, and either way, you're doing a similar thing, but you're essentially being the other side of the market. You're being the house, right? And so you're profiting off of this volatility. So selling puts is really good in this environment. If you think we're at a short-term bottom, you get great premium because everybody wants to buy those puts from you, and they're paying out the nose for them, right? Because they think the sky is falling. If you have an edge and think, hey, I know this stock, I think it's bottoming. Maybe I'm wrong. I want to take a kind of middle of the road play, and basically collect some of that juicy premium and say, I don't think it's going to go down to the strike that I'm selling. I don't think that SPY is going to 400, so I can sell that 400 call or 400 put, and then as long as it doesn't go under there, you just collect the premium because that put that you sold just withers away over time, hopefully, right? Be sure to do your own research and really understand these strategies before you trade them, because it can freak you out sometimes if you don't understand what's happening and you see the percentage moves and you don't really know, and you're like, oh, maybe I'm going to sell a ton of puts because it's free money, right? And then all of a sudden some tail risk, some small percentage event happens, and it can nuke your account pretty quickly if you're not careful. But in general, I think these are some ways that you can trade options in this market without shouldering the weight of this increased volatility premium yourself. Great question, Rocky. Top recommended tech ETF, QQQ, keep it simple. The other one that's a little more focused is XLK. XLK is a little more focused. There's some weird stuff in the Qs that maybe you wouldn't consider as obviously tech. So XLK is a little more focused. Some other ones that I'll mention are SMH or SOX or SOXX. Those are both semiconductor indices. They're just weighted a little bit differently. And then you have IGV, which is a software ETF, software as a service. One more that I'd say keep an eye on is Hack. And I believe there's another Bug as well. But these are cybersecurity sectors. And really quickly, I'll mention it because I like the sector a lot. Cybersecurity is really cool because you get the high beta moves, or like the extra juice. So if a stock has a beta of 2, for every $1 SPY moves, it'll move $2. So you get this high beta, the juice from tech stocks, but you get some of the defensive aspects, because if situations get really wild in the world, in the geopolitical environment, then there's going to be a flight into these companies that protect against that, right? So that's super interesting. It's a nice dynamic, and I think there's a lot of asymmetrical opportunities to be long in things that aren't affected by the stuff of the crises du jour, so to speak, all the tariff stuff. So software as a service is affected by tariffs, and cybersecurity in particular, their software as a service, their services that they provide actually will often inverse the QQQs, because if something crazy happens, you need to protect yourself. So yeah, keep an eye on those, I'd say. Great question. All right. Alito says, I know you talked about dust earlier today on Trader TV. Thank you so much for tuning in. I appreciate that. You are in GDXD and would love your take not only on the ticker, but also on your general reasoning or TA when it comes to the bear sentiment of GDX. Okay, great. Let me switch over to my charts real quick and we can dive in. We can talk about that for a little bit. So gold, I'll tell you right now, it's a tough one. It's such a crazy mover and it's such a momentum trade that I know I said that I took a nibble short, but I might be just completely wrong and I might get backed off hard. So we're going to keep an eye on it for sure. I'm going to keep rambling here while I pull up my charts and log in and switch tabs and all that and exit out of the Easter sale bonus window there on TradingView. Okay, let's switch over. Get rid of that and bring up this. There we go. Pop this out so we can see a little better and let's do something like that. There we go. I know I got a pretty face, but you don't need all of that in your face. Let's get the charts in there. So what was the ticker? GDXD. And I am going to also Google what GDXD is. I know it's gold related. Microsectors gold miners 3x inverse leveraged. Okay, so it sounds very similar to Dust here that I'm trading. And yep, the chart sure looks similar. So when miners go down, this goes up. Why I am choosing miners to express my potential short gold trade is because I think that they have been kind of drifting up, and I think it's been a little bit unfair in terms of if we have downside, I think that they will get hit the hardest. They have the most kind of drag. Like there's a lot of factors that go into mining gold that aren't just gold goes up, right? You know, if energy is going up, then things get more expensive. It gets harder to mine the gold. You know, there's a lot of factors, and I've had good success trading these, trading the miners to the downside and the actual commodity to the upside. So that's generally my bias. There are environments where that changes, but that's kind of how I'm looking at that. So in terms of a TA overview here, it gets a little messy on these 3x ETFs because, you know, it's just you have the decay sliding over time. These things are designed to lose money. So only trade these and swing these in particular if you really have a strong conviction in a move. As I said, I didn't. So, you know, maybe I shouldn't be in this at all. Maybe I'm going to get my hand slapped, but, you know, we'll see. We're in the market. We're in the arena. We're trying things, you know. So in general, you have a big falling pattern here. We have really high volume in the past 2 weeks, and that's the thing that really sparked my interest. So I would view this high volume here as potential capitulation, and maybe we get one more move down and it posts even higher volume and maybe resolves up. So that's what I'd be really looking for. That's a sweep of a major kind of level. And, you know, we can look at that like, all right, all of the bears, they made their money, all of the bulls, they're panic selling. And obviously we're talking inverse, right? So all of the bears are getting stopped out of gold essentially. And all of the bulls are saying, okay, we've had a great run. I'm going to lock in profit here. And, you know, so I think that there's potential to the upside here. I think it's going to be a scary trade. I think it's going to be hard to time, but I like that I got somebody in there with me. In general, I'm going to go to Dust because I'm a little more familiar with the chart. But yeah, it's the same chart, right? So we have gaps here. We have gaps from when gold was just gapping up day after day. And so I think that there's a pretty decent chance that we get some kind of mean reversion to fill in some of these gaps. And doesn't mean we clear this. That'd be quite a feat. If we did, I'd be looking for some kind of head and shoulders like that. But in general, I do think that there's good potential to kind of retrace and fill some of these gaps. So that's kind of my perspective on gold right there. Thanks for the question. All right, Rocky, you love my insight. Thank you so much, and would appreciate information on my company. Yeah, so that's Trade the Pool. I think Tim got you hooked up right under there. There's great resources to show what we're all about there. I don't usually trade prop firms, but these guys got me started. It's they got some really good arrays of products. For example, they have a flex account. I like swing trading, and I don't like. They have a swing trading account. So that's great. That's great for me. They also have a flex account where you don't have a time limit like all these other companies do. So, for me, I like to really pick my spot and be patient. And, I trade multiple accounts, so I'm not trading this every day necessarily. But when I see a fat pitch, a really good trade that maybe, I don't want to have to feel like I'm pressured to take a trade every day, for example. So there's great options there. And they just keep rolling out new stuff. So it's good stuff. I won't pitch the book too much because there's a great link there. But if you're going to trade with a prop firm, I think this is the way to go personally. All right, my buddy VSync. Speaking of healthcare spinoffs, and spin-offers, we have big moves in BHC today. Yeah, let's take a look at that. Ooh, look at that. All right. So I believe this is something going on with some maybe activist investor situation, I believe. VSync, you know more than me, but let's just go pure technicals here. I used to trade the heck out of this, so it's all marked up, as you can see. We'll take out these old lines, start fresh. So we have this big swing low. We posted a big green candle, starting to get some significant volume there. And so it kind of held this zone. We can zoom in a little bit and do this. We can draw a support section, a support zone off of this wick right here, right? Because this was a massive capitulation move on massive volume. I remember this happening live. I remember Spencer the GOAT. I don't know if you're in chat right now, but he was buying at $4 down here, like a Chad, 450, I think. He was definitely under 5 and instantly up like 30% on the day. The next day. Yep. So he was buying right around 450, I believe. So what does that tell us? That this big wick, that is where buyers stepped in. And if we go back further, you can see that it held another previous low, or it actually tagged it very precisely. Look at that. So on the weekly, we can look at that. And that is just ding dong right there. So TA just works, guys. It's all about how you use the tool, but it's crazy the level of precision that this stuff will unlock in your toolbox. It is possible to catch some of these crazy moves, or at least to see this happening and have it inform your bias that, okay, if it held this close and then started rocketing off of that, that's probably a good short-term bottom there. So we have informed our bias that this is the demand zone, and we're starting to show a willingness to buy here. So some things that we can look for, there's a little gap right here. I would like to see this test and then flip to support. And I would like to see the weekly candle engulf. So again, kind of over this wick area. And we can also see an imbalance right here. See that little gap between the bodies of the candle? That means that on the tape, there's some empty space there to negotiate. So the market loves to come back up and fill those and bounce around in those imbalances. I'll show you one, for example, and how I traded it. See this imbalance right here marked on the SMH chart. It wicked up once, it wicked up again, and it soft rejected, but decently. And when I saw that it couldn't break through a third time, I got short right up in the top of this candle. And that was my overnight 13% SOX move there. So yeah, this is just one way you can look at these imbalances. I will probably do a lesson pretty soon on going into more detail about these order blocks or demand zones that I'm talking about, and imbalances, some of the concepts that you might hear, getting bounced around in the ICT trading community. That's where I learned a lot of my stuff. I think that's not the only place to learn them, but I think that is a good resource, and we can talk about some of that in the future if you guys are interested. So yeah, let's see. What else do we got here? What else do we got? Do I have any tech stocks that people may not know too well that have been catching your eye for a long-term hold? Yeah. So maybe not like the most original ideas in the world, but I am really focusing on quality here, on really high quality names. And that's because I'm not sure about our economic outlook. I think that tech is probably going to get dragged, and it might be a long drag. It might be a 6-month bear market where we grind down and then have a major rally and everybody's like, oh my goodness, it's saved. And then it just dumps extra viciously. So, that's kind of where my head is at with tech, but there are names that I'm accumulating. So Uber here, I was buying down here, as you can see by my profit loss, it's cooking really nicely. And I was buying at 65. And that was because, like we just talked about, this long-term demand zone where we can go all the way back and see this wick. So I drew this wick. This was resistance. We surged up, we negotiated it and surged higher. Then I was watching the back tests here and starting to accumulate here. And I didn't do anything here. I got scared, but then it recovered very fast, overshot. Good time to take profit over this zone. and then came back and it held again. And so bought a little more here and then came back again. And my whole thesis here is that this is a really long-term hold, and they're an amazing company. They have high free cash flow. The more expensive they get in terms of share price, the cheaper they actually are in terms of PE, because they just keep performing so excellently. So this is one name in particular that is a tech name, but it's also a value name. So it's kind of a unicorn in that regard. And I would expect nothing but great things from Uber on a 3 to 5 to 10 year horizon there. That's a great one. Let's talk about a few more real quick. Hood. Absolutely. Did I miss one there? Oh, from the Discord. Yeah, thank you for joining in there. I will after this question, I will pop in there and check out what's going on, and we can talk about that. Really quick though here. Hood is at a pretty key 50 level or 50% retrace. And if we are getting a cup with a handle pattern, then I would expect this to be a zone where we start accumulating, where long-term holders start accumulating to build a position for a move that might look like up out there and then surging and sweeping some of these highs up here and some of these kind of fib targets that seem crazy right now, but I'll tell you, when these patterns work, they work. Palantir is a very similar one with this cup, and this one was different because it just consolidated here and squeezed. But yeah, just some things to consider there. Any other tech companies that I think are worth watching? I like TEM. TEM is Nancy Pelosi's AI stock of choice. I think that they have pretty solid fundamentals. They're definitely a growth company. They're definitely speculative, but it looks to me that they're starting to catch and starting to be accumulated in the bottom of this big trading range. And we got a nice falling wedge. It is holding above. It looks like it might come back and back test it. So I'll be watching TEM to make a higher low, and maybe does something like catches around 38 to 40 or something. So just a few to put on your radar. Doing a quick scan. Anything else jumping out of me? I'm really not interested in much tech right now, to be completely honest. You know, the big boys like Amazon, Google, I think those are always great names. One more. We can talk about Tesla for a second. Oh, wow. This didn't play out, did it? I was a bull back there. So yeah, Tesla is interesting. It's trading. It backfilled some gaps. This was a big level of support previously. We could be seeing a double bottom. I'm not convinced though. But if you are looking for tech names, keep it on your watch list, because when it starts moving, it'll move really quick. And I do believe that we will see higher levels on Tesla eventually. All right, let me check in with our comment from Discord. Tim, feel free to point me in the right direction. Oh, is this, does adding Palantir make sense? Is that I'll answer that, and then I'll keep looking and see if I'm missing any others. So El Rozo asks in Discord, does adding Palantir here make sense for indices stocks? It seems up and coming. Absolutely. Background noise where I'm at. Gotcha. Okay, so yeah, let's look at Palantir. Crazy move, right? So I was thinking that this was a head and shoulders, and it needed to come back and test our long-term resistance flip to support level, just like we did on Uber. But this thing is such a crazy mover, and it's hard to say. So it's got a lot of things in its favor. It's been, the darling of the military industrial complex since about down here, at 14 maybe, when they started getting big contracts. So I don't see Palantir going anywhere anytime soon. I think that if you're a long-term investor, you can just buy every time it feels exorbitantly oversold. Like down here in particular, I personally I was short, and then where was I short from? Oh, it was this trade here where, yeah, I was shorting this and caught this move, and then I saw it consolidating here, and I was like, I don't know, I think I got to get out. And I grabbed a little bit of a long, not enough, but just every day it would just drift up, gap up. And I got all out here because I was like, oh, we came back to this level. It's probably going to trade in this box. And then it just went crazy without me. So if you don't want to miss these big moves, you just buy when it seems oversold and you just hold for the long run. It might swing you around and whipsaw you. These names do that. I mean, these are not small moves. That's a 43% drawdown, a 50% drawdown. But, in general, when a stock reprices 50% to the downside, it's going to find buyers. And, it did. It's rallied probably 25% off of that. Oh, wow. 40% off of that. Crazy. So yeah, there's good opportunity in some of these names. I will say, I think there might be better opportunities. Personally, I would say don't pull the trigger yet, unless you're sitting there in all cash and I need something with if the market goes up. If the market goes up, this will go up. And I would be watching what it does in this imbalance zone here, from 107 to 112 if we get that high, and obviously the 100 level as well. So something to keep an eye on, for sure. That's a tech name that I am a fan of. It's just moved so wild that I'd like to see it tighten up. And if you'd like to know why, you can refer to my volatility contraction patterns webinar that I put up a few weeks ago on Trade the Pool on YouTube. You can go to their live tab and you'll see all of the stuff there. Just look for my pretty face and you'll find these. But yeah, we talk about why volatility contracting is something that bulls look for to add to winners. And this is a great example of a stock where you're looking for it to contract and get tighter so you can add to it. For me, this is still a little wild and swingy, but maybe we're starting to see a little contraction here, right? We had big candles, then contraction, push up, contraction. So it's not a bad look. If we have a green week next week, I would expect Palantir to do really well. Thank you for your question. Sorry, I missed you there. Absolutely. Yeah, absolutely, El Rosso. So the question is, is Palantir indicative of the overall market sentiment? So since it is so contingent on growth being a prioritized factor in what people are looking for stocks, for longs, when Qs are up, it means that we're risk on, pedal to the metal. Let's go, baby. Let's buy some growth names. They maybe don't have high PE or low PEs now, but you're betting on future returns more than anything else. So yeah, absolutely. Great question. Let's see what else we got. Mike Koza would like me to analyze HTZ. Oh boy. I'll be honest, I'm not sure how much there is to analyze when you have a chart that looks like that, but we can talk about some things. Feel free to chime in chat if anybody knows the why of this candle. I'm not sure why this happened. Something happened. So what we can talk about is on a high time frame here. What do we got? Look at that, super clean. So why I chose right here is this was the capitulation at the bottom of the range when it gapped down and then showed buyers, and it never broke below that. So there's your low and there's the high, right on the high of the body of that candle. We can zoom in a little bit. So I did that, and look, lo and behold, this is held as support. And let's use our measuring tool. How long did it consolidate there? It consolidated there for 44 weeks, almost a full year. So what does that tell us? It tells us we're at the bottom of a long. Oh, Bill Ackman jumped in. Our buddy Bill. So interesting. We have some shake and bake in the dynamics of shareholders in the company, major holders, and it seems like shorts got squeezed real bad on this. So there's some things that we can look into for TA for this, like this, and it's some things it's more of a mechanical thing where somebody is just buying a massive amount of it and driving it up, right? Yeah, Bill Ackman adjusted his funds. I'll pull this up. Oh, you already had it up. Bill Ackman adjusted his funds holdings and revealed that they are now at 19% because he sees it as a resilient stock even in a recession. Absolutely. Okay, that makes sense. So Bill Ackman's a buyer, and he's probably a buyer because he has his fundamental views, and probably his technical analysis guys, his quants are saying, hey, it's holding this previous zone. It is showing resilience, and it's mirroring his fundamental analysis in the technical analysis. So that's what you always look for, the confluence between it. And that's why I'm a big fan of CanSlim trading. William O'Neill, Jesse Livermore is kind of the precursor to that. People like Mark Minervini, all these guys are all about the confluence between fundamentals and technical analysis. And you can't have one or the other. How many times does a crypto chart look good, a shitcoin chart look good, and then the bottom falls out because somebody sold because the fundamentals were terrible. Some guy could rug pull it, so that's an extreme example, but it is a good example. So in this, I think that this is the story of the tape here. The tale of the tape is that we had a major low here and it went crazy. So clearly this is a stock that'll move pretty big once it gets going. So heck, if you're already in, congratulations. If you're not in, maybe look for some consolidation, but I would expect it to go much higher. I see an imbalance here that it would like to fill. We have the $10 level, which probably has been in play before. Yeah, we look back and $10 was a relative support level in there. And yeah, Spencer says time to pop off. Yeah, this thing's popping off all right. So what we can do is we can also say, where did it sell off from? It was ping ponging around in here, and then it finally broke through. And we can look at the last bull attempt here to kind of get our resistance. So came down, bulls tried to hold it up here, and then it failed, right? So when it broke below there, this is considered a bearish order block. And all that means is that was where bears reloaded and then said, it's time to send it. Let's go. So we can watch for a range between here and there, roughly. And we can track what it does at the 50% mark of that. And, usually I do the major swing high to major swing low, but heck, that doesn't really tell us much, right? There's so much room. So I like it right here. I like it right around there. And we can watch what it does. And look at that. You'll often see this. The confluence of the middle of a range is a round number or a major area of interest, right around $10 in this case. So I think if we actually hone in a little bit and we do the top of this last red candle, it'll probably be, look at that, $10 to the penny. This is not a coincidence. This is precision range digestion and all this kind of stuff. So from the very second that this came down all the way to where it caught long-term based on the buyers down here, the exact equilibrium or basically decision point of this range is whole number, $10. I don't know if Hertz was ever, I probably wasn't a SPAC. You'll see that a lot on SPACs because they start at $10 and lots of volume trades there. But this will be the decision point. $10 will be the line in the sand. If we close majorly over that, we're probably going a lot higher. If we reject there, maybe it needs to come back and rebase. Like, this popped pretty nicely too, but then it needed to come back and redigest before it surged. So a really great example. I love these live examples where I have to kind of discover the secret in real time. It's such a fun puzzle, and obviously I'm missing a lot of things. I'm just looking at this now, but there's always so much to be gleaned from any chart. So as you learn with me here and learn some more TA, you'll start seeing this stuff jump out on your screen too. And it's a very validating and rewarding thing. So I hope you're as entranced by this kind of stuff as I am, because I find it so cool. Let's see what else we got. Ali asks, your technical is for swing trading. How about day trading? I think it's all fractal. I think anything I'm talking about on these macro levels works on the micro levels too. You can go all the way down to 15-second charts and you'll see the same exact patterns playing out. So for me, it's all about taking my high time frame bias and honing in to down to low time frame biases. So even if I'm scalping a minute chart, like I was yesterday at close or near close the last hour during that crazy Ripper rally, I caught the move down and then we were live tape reading in this room. So if you ever see me in here, pop in, and we caught the bottom there too. And we were walking through in real time what I was looking at, why I changed and got out there, why I started looking long, why I got long. And all of those biases were all influenced by my high time frame biases of where I thought we were going on the daily chart. So don't get too hung up on, is this a day trading system? Is this a swing trading system? Sure, there are some differences, but for the most part, in terms of technical analysis, it applies across the board. Great question. Great questions. Thank you. All right. Let's see. Short term, meaning considering earnings next week. I am in Tesla Q when it comes to Tesla. Bad idea. So Tesla is pretty contingent on news, and I am biased downside to the bearish side. I think we're putting in top wicks here. I think the daily was trying, and with these bottom wicks, I saw these 3 bottom wicks getting cut tighter and tighter, but then it broke down. Sure, it's posting another couple bottom wicks here, but I think that it's going to keep negotiating down and sweep these equal lows, take these stops out. And we can zoom out a little bit, and I think more solid support is going to be, I see like a double bottom here with a neckline around here. It was a valid zone here, broke out, back tested, broke out. So I would maybe draw something like that as support next. And I would want to see what it does. Yeah, right around there at 200. So I think that probably that's the next stop. But hey, like you mentioned, we're coming into earnings. I don't know what Elon's got cooked up his sleeve. It could be some wild stuff. So If you get your move that you're looking for into earnings, I'd highly recommend sizing down, and then you can leave runners for the big move down, which I would say is decently likely, maybe 60, 70% chance. Never 100, it's always a wild card with the earnings, but that's kind of where my head's at there. Thanks for the question. And let's see, we probably got about 10 more minutes here, and then I think it'll probably be time for me to wrap up. So I will answer as many questions as possible. And if I don't get to you, hey, you can shoot me a DM and Trade the Pool server. I'll try to get to you as soon as possible there. You can come back next week. We'll have more to talk about. Yeah, absolutely. I will hang out for, let's say 10, 15 minutes in the Trade the Pool Discord as well after. And if anybody wants to come in, talk shop, hang out, whatever you want to do, we can do stuff there too. But I do have to wrap up this video for time's sake pretty soon here. So let's see what else we got real quick. Oh, great question, Mike. What are my favorite top trading books? So, top book of all time is one that maybe won't be as exciting as you would expect, but Trading in the Zone by Michael Douglas. He is the king in my eyes of learning the mental game of trading, and that's the hardest part. I'll be completely honest. As a technical analyst, yeah, that's the word. As a technical analyst, I will be the first to say that's not really the hardest part of this job. The hardest part is executing and managing your emotions and not trading yourself under the table and missing all the setups that you're watching, right? So there's nobody that I would recommend higher than Trade Zone or Trading in the Zone by Michael Douglas. It's an amazing book. There's a free audiobook on YouTube. Listen to it, let it sink in, listen to it again. Listen to it while you're walking your dog. Listen to it while you're trading the markets. Listen to it while you're taking a bath. I don't care. Just listen to it. I promise you, you will become a better trader because of it. That's number one. Market Wizards by, I forget who wrote it, but it's about Mark Minervini. It might just be Mark Minervini himself. That's an amazing book. He has a couple of really good books. Mark Minervini is an amazing resource. I think that he is a phenomenal trader, and that would be a couple books that I'd recommend. Any book by him. I think that, start with his first and work from there if you like what he does. The Tao of Trading. I also forget who wrote that, but that's another excellent book. And let's call it those three for now. But if you get through those and you want more, hit me up because I've read my fair share and there's some really good stuff out there. Awesome. Great question. Thank you. So let's see. It looks like I've worked through all the questions here. I will double check. Let's see. Oh, Stuart. Hey, good to see you, man. Glad you're back here. Hey, Steve. One thing I have trouble with is to have some idea of when to come out of a trade as it's squeezing up. You have any tips that could potentially help? Absolutely. Yeah, great question. It's super hard, right? Because when you're breaking ranges and it's all going crazy, it's really hard to predict. So actually, how about here's one that I traded this week, USAR. It beat me pretty bad today on my runners, but as you can see this chart, I was getting out and de-risking up here. So what we can do is we can have a fib range over the big range if it's trading in a range and it's squeezing up off the bottom like this. That can be very helpful. And then we can say, okay, we're through the 50. We back tested it once. We're off to the races. Let's see what we do at the 7-8 or the 6-1-8. So the 6-1-8, we bopped our head, but then we back tested it and we pushed off again. So this is where the sellers really stepped in. And why I was getting out in this yellow box here is because on the daily chart here, this is where these two wicks are. So these two wicks were when it surged up initially and consolidated. And this is where sellers said, nah, not yet. We're going to buy this way cheaper later. So this is where the big boy seller is. And kind of looks like he's still there for now. If we start consolidating up here, let me draw that out. Maybe we do, whoops. We do some flagging like that in a pennant. Then maybe we can flip this and then you'll get a real squeeze through the top there. So if you're in a situation where it's a real squeeze like this and like blue skies ahead, I think what you can do is you can use a topic I talked about in my Bulkowski pattern trading seminar a few weeks ago. And that was essentially when we have a trading range and it breaks, we can, whoops, I had it the right way the first time. There we go. We can look upwards at the two biggest fibs that I watch for. So 1.62 or 618, if you want to get granular. This is, it's over half of this range, this whole range, and this is a major level of where a lot of algorithms will trigger, a lot of old school Fibonacci traders will sell, and it's a heck of a move, right? So you can watch that closely. And then the big one is the measured move overall, the 2 times of the base. So it's a little tricky. There's a lot of variability. And the biggest thing I would say is when you see big sellers, you got to respect that because momentum can shift really fast. So I wish I sold more up here. I got my trim off and I'm very happy with that. And now I'm looking to reload if we hold this 50 fib in this imbalance here. But, it happens so fast on these, where it's just boom, and the seller comes in and everybody, freaks out and gets out of the way. So yeah, that is where we're at there. We have a few more minutes, and Michael, you're right. I didn't look at the PFE chart. I wasn't on my charts when I got to your question. So let's look at that. Gotta say, looking ugly. Let me get rid of these lines. They're old and messy. There we go. Start fresh. So whenever I have to go to the monthly chart to find support, I know it's rough times. So let's figure out if this is a valid buyer and what we were seeing there. So on this big expansion move up, we had, looks like a zone there, but it didn't negotiate yet. So what else do we have? Let's go to quarterly. Let's go back further. Looks kind of valid. Say there's a level around there. I'd say there's a level around here. I think deeper support is probably in here though. And man, that's still a ways away. So let's hone in a little bit and see if we can figure out where we could expect to find support. I'm going to redraw this. Oh geez, keep grabbing the wrong thing. There we go. Snap it here. So I'm choosing this level here because this broke this range. It was a double bottom. And basically, so this was the swing low, right? And this kind of confirmed it when it made a new high here, and then it held here, and then it pushed through this level again. So you've heard me say this a few times. This is called an order block, when sellers try and then bulls overpower them. So you can look at the traders that traded in this as you can personify them, that cohort of traders, as a bullish big buyer, right? Because it came down, but it wasn't to go lower. It was to give them entries and then push it higher and higher and higher. So this is an area of interest when we trade back into it. We are just kind of trading into this drift up, or this surge up here. So this is kind of what I would consider poor market structure. This is what I would consider constructive market structure. So I'm not surprised that we just knife right through this stuff, right? See, this was more solid, and we consolidated there and negotiated it. And we tried to go up and then failed. So you could consider this a bearish order block, because the people who were trying to go long ended up getting overpowered by the shorts. So this is our resistance. This is our support. I would keep an eye on this level here, 2027. You can call it $20 for ease of to keep it simple. And so for Pfizer here, I'd be watching the $20 level. I would be expecting the $20 level, and I would be keeping an eye on what it does there for a change of character. So, when we start seeing something like this on high volume where it comes down and then goes up. And if you're interested in change of characters, you can check out my last week's webinar about when to buy the crash. And we went over a lot of examples of what that change of character looks like in more granularity and more detail there. So thank you so much for the questions there. It looks like I am out of questions, and it looks like I'm out of time. So I'm going to sign off and enjoy this Easter weekend. I hope you all do the same. Thank you so much for joining, and come back next week because we're going to keep having fun. Thanks, guys.